So good evening and welcome to our PFT class today. So we are doing employment income. So we will look at illustrations, class illustration questions. So the first question I want us to look at, kindly turn to November 2020. November 2020, question 3B. So November 2020, question 3B. From Shali Kanini. November 2020, question 3B. Shali Kanini.
Excuse me, sir.
Yes?
Where can I get the questions? Where can I refer to from?
They are online. Si uko na net, you can download from CASNEB website. There are number. Ukienda tu online, useme CASNEB, November 2020. So you'll be able to see November 2020, then you can turn to question number 3. 3B is called Shali Kanini. Once you get it, let me know, then we'll be ready to start. So we'll say CASNEB PFT, Public Finance and Taxation. Then you look for November 2020, question 3B. So November 2020, question 3B will be our first question. So as soon as you are ready with the question, let me know. Then we'll be ready to start.
Yeah, no, the cash account.
Somebody should mute themselves. Are you guys ready? You have the question?
Just a minute.
We are okay now? We have the question? Do we have the question now? You found the question? Elisha, umepata swali? Elisha, are you there?
Najaribu kutafuta hiyo.
Bado.
Bado na.
Swali haipatikani kabisa, Elisha. Basi umepata sitting gani? Because we'll spend an hour here looking for the question. Wewe uko na sitting gani? Tuangalie kama kuna employment income huko.
Bado nilikuwa naangalia sasa.
Umegoogle ama unatafuta wapi? Elisha, you've Googled ama unatafuta wapi? Umegoogle Casnet?
Niko na document na
Uko na document?
naangalia.
Mbidhi umepata? Umepata November 2020. Mbidhi, you have
Not yet.
November 2020?
Not yet.
Mnatafuta hizi vitu wapi?
Yenye nimepata aina ya 2020.
Unasema?
The document yenye nimepata aina ya 2020, 2015 to 2021, but they have skipped 2020.
Or they've skipped 2020. I can still pick a different question. There's no trouble. Kama hiyo inaleta shida, we can still pick a different one.
But that will be better.
Okay, let's pick last sitting. If it's easier for you, tafuta April 2024. April 2024 is not even last sitting. Last sitting was August. Lakini tafuta April 2024, there's a question 3 pia on employment. April 2024. April 2024, question 3C. April 2024, kama hiyo 2020 kaleta shida, let's get April 2024.
Sawa, hiyo nimepata. Na nimepata April 2024.
April 2024, question 3C. The name of the question is called John Musioka.
Yes, I'm there.
Let's read the question. So the question reads, John Musioka is employed as a finance manager by Safari Real Estate Limited. He reported the following details of his income and that of his wife for the year ended 31st December 2023. 1, he was entitled to a basic salary of 400,000 shillings per month. Payee was 120,000 per month, was deducted. 2, he was also entitled to an annual bonus of 120,000 during the year. The bonus for the year 2023 was, however, not paid until February 2024. Three, the employer provided him with a motor vehicle, 2,600 cc, that had cost the company 3,200,000 in the year 2021. The vehicle was valued at 2,500,000 at the beginning of the year. 4, his annual mortgage repayment of 820,000 inclusive of interest of 180,000 was settled by the employer. The loan was obtained from Elite Bank on 1st January 2023 to purchase own residential house. The following deductions were made from his salary during the year: subscriptions to Jenga Golf Club, contribution to a registered pension scheme. He received a gross dividend of 80,000 from his shares in Safari Real Estate Limited, where the withholding tax was paid by the company. 7, his wife, Janet Musioka, is employed by Bright Farmers Cooperative Society as a general manager at a basic salary of 160,000 per month. She is housed with the Cooperative Society's farm, where she contributes 5% of her basic salary as rent. She received free farm products or produce worth 24,000 during the year. Then 9, her other income comprised of interest income is 10-year infrastructure development bond, 120,000, interest from Wema Development Bank, 85,000 net. Gross farming income of 240,000, excluding family consumption valued at 30,000. 10, John Musyoka and his wife, Janet Musyoka, have been filing separate tax returns to the Revenue Authority. Ignore computation of affordable housing levy. Required, compute the taxable income of John Musyoka and his wife, Janet Musyoka, for the year ended. Determine the tax payer. All right. So want to prepare a statement of taxable income. Actually, they want us to compute the taxable income of John Musyoka and his wife. So I'll title this Mr. and Mrs. Musyoka. The wife is called Janet. So question 3C. So say Mr. and Mrs. Musyoka. So you are preparing a statement of taxable income for the year ended. Use 2023 as our year of income. So we'll start this statement by looking at Mr. Musyoka's income. So we'll start with Mr. Musyoka, yeah? So line by line. Number one, he was entitled to a basic salary of 400,000 a month. So we'll come here and say basic salary. $400,000 per month, multiplied by 12, because the examiner wants the taxable income per annum. So we multiply this 400,000 by 12 to get for the year. So for the year is 4,800,000. That's his basic salary. $4,800,000 is the basic salary. Then you continue note 2. He was also entitled to an annual bonus of $120,000 during the year. The bonus for the current year was not paid until next year. So you will only tax the bonus when it is received. So employment income is taxed on a cash basis. You don't tax it on accrual basis. So you don't accrue the income, we'll tax it when it is received. So we'll ignore note 2. It's not yet received, it's going to be paid next year. It was not paid until February 2024. So that's when it will be taxable. 3, the employer provided him with a motor vehicle 2,600 cc that had cost the company $3,200,000 in year 2021. The vehicle was valued at $2.5 million at the beginning of year 2023. So there is a motor vehicle or car. So we begin with CC basis. So you go to the top of your past papers, you're going to find rates there, and you look for 2,600 cc under motor vehicles. So 2,600 cc is between 2,001 to 3,000, and the rate is 8,600 per month. or 103,200 per year. So I'll put here 103,200 per year, which I must compare with something else. 103,200, compare with 2% per month of the initial cost of the car. So the initial cost of the car, not the current value, but the initial cost. The initial cost of this car when it was bought was 3,200,000. So 3,200,000 was the initial cost. Then you multiply by 12. 2% is per month. We said that's the rate per month. So I'm getting 24% of 3.2 million. And that's 768,000. Then I put my parentheses. I'm comparing the two. Out of these two, I choose the highest. 103,200 or 768,000. The highest is 768,000. So the value of benefit for the car is 768,000. $768,000. So that's the car. Then the next note is note 4. His annual mortgage repayment of $820,000 inclusive of interest of $180,000 was settled by the employer. So the employer paid his mortgage. The loan was obtained from Elite Bank on 1st January to purchase his own residential house. So we'll get mortgage. Mortgage repayment. This is repaid by the employer, so it's a benefit. So when the employer pays on your behalf, then it becomes a benefit. So the employer paid $820,000 for mortgage. So that's all a benefit. Then note 5, the following deductions were made from his salary: subscriptions to Jenga Golf Club, contributions to a registered pension scheme. So deductions will come after we've already added all the benefits, then we'll deduct allowable deductions. So we continue, we'll come back to deductions. He received a gross dividend of $80,000 from his shares in Safari Real Estate Limited, where the withholding tax was paid by the company. So the only benefit here is the withholding tax on these shares, which was paid by the company. So withholding tax on shares is 5%. So we're going to say withholding tax on dividends. Withholding tax on dividends. This is paid by the employer. So that withholding tax is 5% of 180,000. 5% of 180. The 5% is the rate of withholding tax. So 5% of 180,000 is 9,000. So it was paid by the company. So you include it as a benefit. They paid withholding tax for him. The company paid that. Note 7, his wife, Janet Musioka, is employed by Bright Farmers Cooperative Society as a general manager at a basic salary of 160. So that's the wife's employment income. Will show separately on her. She's housed within the cooperative. Again, that relates to her income. She received farm produce, her other income. Okay, so let's finish with this. So these are the incomes of John Musioka. We want to deduct allowable deductions. So the first allowable deduction we want to deduct is note 4, the mortgage. They're saying his annual mortgage repayment, the total is 820,000, inclusive of mortgage interest of 180. So the first allowable deduction, we are going to lessen mortgage interest. So let's deduct mortgage interest. So you take the actual. So the actual mortgage is 180,000. Then the maximum set limit. Set limit for mortgage per annum is 300,000. But for deductions, you choose the lowest. So the lowest to deduct is 180. We deduct that. That's mortgage done. The other deductions are in note 5. Subscriptions to golf club does not give you a deduction. We said subscriptions must be to a professional association, but contributions to a registered pension scheme can be deducted. So we also lessen contribution to registered pension scheme. So you get the actual contribution. So the actual contribution to the scheme is 180,000 per year. We'll compare with the set limit per year. So set limit for contribution to pension is 240,000. Out of these two, again, deduct the lowest. So deduct the lowest is that. So we are done with the husband's income. So let me just get this total for the husband of Mr. Musioka. So 4.8 million. We add plus 768,000. 768,000 is motor vehicle benefit plus mortgage repayment by the company, 820,000, plus withholding tax on dividends, the company paid for him 9,000, less 180,000 for mortgage interest, less contribution to pension, another 180,000. The final amount is 60,37. So that's the taxable income of the husband. Now we get the taxable income of Mrs. Musioka, the wife. Taxable income of Mrs. Musioka. Okay, starting from note 7. His wife, Janet Musioka, is employed by Bright Farmers Cooperative Society as a general manager. Basic salary is 160,000 per month. So her basic salary, $160,000 per month, multiplied by 12 months. $1,920. That's the basic salary. Number 8, She is housed within the cooperative society's farm. So she's working for an agricultural entity. Her housing benefit will be 10% of the gains from employment, but we first have to get the gains, the total gains from employment. So we'll come back and calculate housing benefit. She received free farm produce, and we said you tax farm produce if the aggregate value is 3,000 per month or 36,000 per year. This is only 24,000, so it's less than 36,000 per year. So you don't tax that. You ignore that. So farm produce must be, or those are facilities. The aggregate value of a facility must be 3,000 per month or 36,000 per year. So here 24,000 haitoshi, so unaachana na hiyo. His other income, before I go to other incomes, I think we will first compute housing benefit based on this. So let's calculate housing benefit, because this is the only thing that is taxable. So housing benefit is 15% of the gains from employment. So we'll say housing benefit. We'll get 15% of total gains from employment, 20,000. I want to put it aside here. So 15% of that is 288,000. Then from 288,000, you must lessen what she was deducted as rent. No, it's supposed to be 10%. Sorry, guys. 10, because this is agriculture. So 10% is 192,000, not 15. 192,000. Then we lessen note 8. She's housed within the cooperative society's farm, where she contributed 5% of her basic salary as rent, so less own contribution. Own contribution is 5% of her basic salary of 1920. 5% of that is what she contributed. So I'll get 0.05 times 1920. So our own contribution is 96,000. We deduct from here. So housing benefit is the difference, which is 96,000. $96,000 is going to be a housing benefit. $96,000. Then she has other incomes. So I can even add this total from employment. Then we can bring in other incomes. So total from employment . It's 2016. Then we have other incomes. So other incomes. Interest income from a 10-year infrastructure development bond. So infrastructure development bonds, if the maturity period is 3 years or more, then it is exempted from tax. Like this one is a 10-year bond, so it's fully exempted from tax. A 10-year bond. So if maturity is 3 years or more, then it is fully exempted. So we leave out that. Interest from Wema Development Bank. So interest from the bank, there's a withholding tax of 15%. Withholding tax of 15% is the final tax. Final tax means you don't tax again. That is all. Then there is gross farming income of 240,000, excluding family consumption of 30,000. All right. So normally, if you want to tax farming income, then you test the proportion or the percentage. So I'm going to put a note here and you work out 30,000 out of the total income. What is the percentage? Because if the percentage reaches 25%, then you call that hobby farming. You don't tax a hobby. You only tax commercial farming. So let's get the proportion here. So gross farming income is, I'll take gross income, I'll add consumption, then, sorry, I'll take consumption, what was consumed, I divide by the total. I divide by the gross income plus consumption. If the percentage doesn't reach 25%, then we will tax it. So consumption is 30,000. The gross income before adding consumption is 240,000. Add 30 to get the total consumption, to get the total income, then multiply by 100. If the percent is 25% or more, then I'll call that hobby farming. I will not include it in tax. But if it's less than 25%, we'll include it. So this is 30,000 divided by 270. So what proportion is being consumed? 30,000 divided by 270,000. Then I multiply by 100. So what is being consumed? Only 11%. So 11% is less than 25. So this is not hobby farming. This is commercial farming because it is only 11% that is being consumed. So you say this is taxable income because what is being consumed is less than 25%. So in other incomes here, let's include farming income, the gross farming income. So we'll include farming income because less than 25% is being consumed. So this is commercial farming. So we say gross farming income is 240,000 plus consumption of 30,000 was consumed by the family. Total is 270. I don't think she has any other income, so we can add and get our total taxable income. Yes. So from here, we get the total taxable income. So our total taxable income is the total of this, which is 22,86,000. So this is the taxable income of the wife. So that is the first part of the question. That's the first part of the question. Roman 2, determine the tax payable, if any, on the income computed in C Roman 1 above. So first, before we calculate tax, is there any question? Anyone with a question? Okay, let's now calculate tax on these incomes. We'll calculate tax for Roman 2. So the graduated scale we are going to use has been provided in the question. So yes, we're using the graduated scale per annum. You can see there from 1 shilling to 288,000, from 288,001 to 388, 25%, and so on. So that's the scale we are going to apply here, or that is applicable. So I'll say tax computation. So these are separate taxpayers. So we'll start with Mr. Musyoka. The income for Mr. Musyoka is 6,037,000. So I just say, take the first 288,000. The rate of tax there is 10%. Then I say 10% times this is 28,800. And that is called the first band, 28,800. Then the next band, you say on the next 100,000. How am I getting 100,000? Take the upper limit of the second band. The upper limit is 388,000 minus the upper limit of the first band, 288,000, because 288,000 was already taxed. So 388 minus 288, the previous one, you get 100,000. So the next 100,000, you bring in 25%. 25% is 25,000. And again, you see the next. The next limit should be 6 million minus 388,000. The 6 million we've been given there. So you'll take 6 million. So 6 million minus 388,000. The previous. You take the upper limit of the next band minus the upper limit of the previous one. So that gives you the next 56. Oh, just a minute. This, if I add this, I think it will still be within what I'm taxing. So 5612 at the next rate. So the next rate is the next rate after 25% is 30%. So 5612 at 30% times 0.3 is 1683. $1,683,600. Then you say the next how much? Now you take the whole amount. His salary was 60,37,000 minus this total. So this total must be 6 million. 288,000, whatever has already been taxed. 288,000. 288,000 plus 100,000 plus 5612,000. I think that's 6 million. Yeah, it's 6 million. So minus 6 million. Then the next rate is 32.5%. (32.5%), then you go to 35%. So this will be 37,000 minus 6 million multiplied by 0.325, and we get 12,025. Then you add this to get the gross amount. You can confirm that the total you get is something like 17,49,425. That is the gross tax liability. Now you'll offset any taxes that were already paid. Like payee, any taxes he had already paid would be deducted. Let's start with payee was in note 120,000 per month. So we say less tax at source or TS. So you had paid some payee of 120,000 per month times 12 months. So this is 1440. So we deduct that, was already paid. Any questions so far? Anyone with a question? What else had been paid? Nothing else. So the next thing we deduct is his personal relief. So that's personal relief. Personal relief is 28,800. So that will give us tax payable by Mr. Musioka. So tax payable by Mr. Musioka is 17,49,425 minus 1440,000 minus 28,800. And we get, he's supposed to pay 280,625. Then we have Mrs. Musioka. We were told they are filing separate returns. They are filing separate returns, so we must show their tax separately. So our income is 2,286,000. So we use the same scale. So you see the first 288,000 at 10% will still be 28,800. Then the next 100,000 at 25%. It's 25,000. Yeah. Then we'll get the excess. Yeah. So the excess will be 2,286,000 less 388,000. This time at 30%. So 2,286,000 286,000 minus 388. This will give you 569. 400. Then we add. We get 623, 200. Then again, we'll deduct the taxes that were already paid by Mrs. Musioka. So what taxes had Mrs. Musioka paid? Note 7 does not tell us if she paid any tax. Actually, we are not given any tax that Mrs. Musioka paid, but we can deduct her personal relief. So let's personal. Personal relief would be 28,800. Then taxpayer. So we take 623, 200 plus 28,800, giving us 594, 400. Any question? Anyone with a question? So you can get another illustration. On employment income. Usually every setting you must get, unless something changes very drastically, every sitting you must get a question on employment income, one question. So look at December 2023. December 2023. December 2023, question 3B. December 2023, question 3B. The name of the taxpayer is called Rosemary Aswani. Rosemary Aswani. December 2023, question 3B, Rosemary Aswani. So again, try and get the question, then let me know if you are there so that we can begin. So have you found the question? Mepata December 2023, anyone? So when you're ready with the question, let me know, then we can start. Or you found it. Alicia says, yes, found it. So we'll read the question. Rosemary Aswani is a resident individual who is employed as a senior financial analyst by United Homes Limited from the year 2022. So she's a financial analyst. She has provided the following information relating to her income for the year ended 31st December 2022. 1, she received a monthly basic salary of $204,000 from United Homes and a bonus equals to 1 month basic salary for her exemplary performance. Pay deducted during the year was $607,200. Number 2, terminal dues received from her previous employer for services not rendered amounted to $1,400,000. Her 4-year contract of employment was terminated after 2 years in December 2021, and the payment was made as per the employment contract. 3, a commission of $100,000 was paid to her for promoting the sale of houses where 2 houses were sold to the customers she had referred to the business. 4, she attended a 5-day masterclass for financial analysts organized by her professional body, and the employer paid $100,000 for the seminar, and she was paid daily subsistence allowances of $12,000 by the employer. 5, she was given an offer to buy a house from United Homes at 20% below the market selling price. She accepted the offer and bought one house whose market selling price was $8 million. 6, she has a fixed deposit account of $2,500,000 at Maisha Bank Limited, from which she received interest of $150,000 during the year. 7, she has a life insurance policy where she pays 60% of the premiums while the employer pays the balance. Annual premiums as per the insurance policy was $240,000 for the year. 8, she was provided with a leased saloon car of 2,000 cc by the employer for both personal use and official duties on 1st September. The saloon car had an initial cost of $2,800,000 and lease charges were $36,000 per month. 9, United Homes has a medical cover for all management staff. She was entitled to a maximum cover of 880,000 shillings per year, although she utilized 420,000 on medical costs during the year. 10, she paid subscription fees to a professional body amounting to 24,000 during the year. Her other incomes include royalties, income of 180,000 net of withholding tax, net. Gross farming income was 450, out of which 80,000 was in respect of own consumption of the farm produce. Part-time practice as content creator, where she made 600,000 during the year. Required, compute the taxable income for Rosemary Aswani for the year. Determine the tax payable, if any, with the income computed in B from and one above. So Rosemary Aswani, so statement of taxable income. The year ending. I'm just using 2023 because that will be the year you'll be examined on by your examiner this coming sitting. So again, we'll bring in those items line by line. So she received a monthly basic salary of 204,000 from United Homes. So basic salary. $240,000 per month times 12 months. It's 2,880,000. 2,880,000 for her basic salary. The same point, and a bonus equals to, yes?
It's 204,000, not 240.
Oh, sorry. 204,000, not 240. It's 204 times 12. So 2,448,000 is her salary. Then, and a bonus equals to 1 month basic salary for her exemplary performance. So bonus is 1 month's basic salary. So another 204. These are cash benefits from employment. Note 2, terminal dues received from her previous employer for services not rendered amounted to 1,400,000. I think it should be for services rendered. Why should it be for services not rendered? She received terminal benefits for services rendered. So that was previous employment, 1,400,000. Her 4-year contract of employment was terminated after 2 years. she was paid as compensation for a contract that was not completed. So she had a 4-year contract. It was terminated after 2 years, and payment was made as per the employment contract. So we'll just include that, but the 1.4 compensation for the on termination of the previous contract. But let's first finish with the current employment. Then we'll bring this compensation as So note 3, a commission of 100,000 was paid to her for promoting the sale of houses, where 2 houses were sold to the customers she had referred to the business. So she received a commission of 100,000. Note 4, she attended a 5-day master class for financial analysts organized by a professional body, and the employer paid 100,000 for the class, for the seminar, and she was paid daily subsistence allowance. Okay, so there is a master class. This was paid by the employer for training, and the employer paid 100,000. 100,000. On top of that, she was paid some subsistence allowance, daily for 5 days. So subsistence, also called per diem. So per diem was 12,000 daily. 12,000 daily. 2,000 daily is exempted. Then you multiply by 5. 5 days. So subsistence would be 10,000. So that would be 50. That is subsistence. Now, note 5, she was given an offer to buy a house from United Homes at 20% below the market selling price. She accepted the offer and bought one house whose market selling price was 8 million. So, what would you call this? This, we can say, is like a fringe benefit. Fringe benefit. She got a loan from the company, probably at a lower interest rate. That's why it's 20% below. But this loan of 8 million should be taxed. It's the employer who should pay tax, not her. So we'll just leave that out, unless separately the examiner wants us to calculate the value of that benefit. Then it will be the amount of the loan, 8 million, times market interest rate, minus the low interest rate that is being charged. Actually, the difference is already given. She was given at 20% below. So our benefit is 20% times 1,600,000, times 8 million, then you multiply by 30%. Because the fringe benefit tax will be payable by the employer at the corporation tax rate. So leave that. Note 6, She has a fixed deposit account of 2,500,000 at Maisha Bank, from which she received interest of 150,000 during the year. So interest from a fixed deposit account is taxable at a withholding tax rate of 15%. So the bank will deduct that and remit to KRA. So there's no further taxation. So that interest has already been taxed. 7, she has a life insurance policy where she pays 60% of the premiums while the employer pays the balance. The balance or annual premiums as per the insurance policy was 240,000. Just a minute. You won't walk on the other side? Yes. The key is here. Oh, it's outside. Okay, then where were we? Insurance, note 7. She has a life insurance policy where she pays 60,000 of the premiums, 60%. She pays 60% of the premiums while the employer pays the balance. So the balance paid by the employer, 40%, is a taxable benefit. So we have life insurance. So the portion paid by the employer. The portion paid by the employer is 40% of the annual premiums is 240,000. So this is 96,000 is a benefit. Note 8, she was provided with a leased saloon car of 2000 cc by the employer for both personal and official. So we are only going to tax personal, not official. So if the examiner doesn't tell you what percentage is personal and what percentage is official, you just take 50-50, half-half. Then again, most importantly, the car is given from September, not January. So the car has only been given for 4 months, September, October, November, December. So we'll tax the car for only 4 months. So let's get this car. We start with CC basis. So first of all, we'll get 50% because the car is being used for business and personal.